2018 is off to a very good start for the bank. We saw very good earnings growth this quarter, and our earnings growth was well within our medium-term objective of growing earnings per share of 7% or more. Our net income in the quarter was over $2.3 billion, and our earnings per share growth was over 18%. With a very favorable economic backdrop, we saw good double-digit growth across our personal and commercial businesses in Canada and in our international banking division, particularly in Mexico and Chile. And our global banking and markets division had a good rebound from last quarter. Firstly, our interest income grew by 8%. 2/3 of that growth came from loan volume growth, and 1/3 came from margin expansion. And that good loan volume growth was in Canada, as well as across the Pacific Alliance countries. Secondly, our credit performance remained strong, and our provision for credit loss ratio actually improved from last year. And lastly, we delivered good positive operating leverage, driving revenue growth in excess of expense growth, which really helps drive our overall net earnings growth. And in the first quarter of 2018, revenues exceeded expense growth by 3%. Our structural cost transformation program that we embarked on a few years ago continues to drive productivity gains for the bank. Part of those savings from the structural cost transformation program also helps finance important investments we're making in digital and technology and other regulatory initiatives. Our Common Equity Tier 1 capital ratio remains strong, and it sits well above 11% in the first quarter of 2018. These strong capital levels provide us a lot of flexibility and optionality to support continued investment in the bank, to support business organic growth, to support increasing returns to our shareholders, but also to support acquisitions to strengthen and grow our businesses across our countries. Overall, our strong capital levels will support earnings growth, and we're optimistic about our growth prospects going forward.